It means I have to go back. Okay. All right, so IAS 10 events after reporting period, a very crucial standard. You will see it in almost every company finance conversation. It's crucial. So this is the learning objectives. This is what you want to achieve at the end of the period. Historical development. We should know the historical development of the standard, the scope, the definition of various terms, crucial terms, and distinction between adjusting and adjusting events, examples of adjusting and non-adjusting events, prescribed treatment for adjusting and non-adjusting events, and then disclosure requirement. So about the history, the first version of the standard was issued way back in 1978. Okay, and then with effective date of January 1980 under the name contingencies and events occurring after the balance sheet date. So there's been several amendments, okay, and change of name. The latest revision was in 2003 with effective dates. Please, no video. With effective dates of 1st January 2005 under the name events after the balance sheet date. So that's about it. And on 6 September 2007, it was retitled to events after the reporting period. When you go to iasplus.com, you see all the developments, the various amendments, and the reason why it was amended and their effective dates. You see them. So, what the scope and objective of this standard? This standard is to specify when an enterprise should adjust its financial statement for the effect of events occurring after the end of the reporting period. When we say reporting period, what do we mean? What's the reporting period? The date of the financial statement. Every organization have their reporting period, right? Let's say from January to December, from July to June, from March to April to March. So that's your reporting period. Okay. So the reporting date will be the final day of the period. The reporting date will be the final day of the period. So this standard is to specify when an enterprise should adjust its financial statement for the effects of events that occur as at the end of the reporting period. Is that okay? And to specify what to disclose in the financial statement regarding events occurring after the reporting period. Sometimes these events can affect the going concern of the company. That's why they are crucial. So just to determine whether the financial statement should be adjusted or not for events occurring after the reporting period. Okay. Whether you should adjust the financial statement to reflect them or you shouldn't adjust. If you're not adjusting, then you should disclose them. But under what circumstance do we adjust the financial statement? And under what circumstance do we just disclose these issues? That is what we are going to learn. First and foremost, events after the reporting period. When we say events after reporting period, it refers to those events, being it favorable or unfavorable, which occurred between the end of the reporting period and the date on which the financial statement is authorized for issue. This one, you should grasp it. You should grasp this very definition. So I'm going to use this to demonstrate it to you. So this is the beginning of the accounting period, and this is the end of the accounting period. And this is the authorization date. So the beginning of the accounting period, let's say 1st January 2021, and the end of the accounting period will be 31st December 2021. So that is the accounting period. And note that after the reporting date, this is the report, after this period, it takes some time before the financial statement is prepared and authorized for issue. If you didn't know, I'm telling you today. after the reporting date, after 31st December, or let's say the financial statement does not become available on 31st December, although the reporting date is 31st December, it does not become available on 31st December. So after the reporting date, it takes some time before the financial statement is prepared and auditors come in to go through to audit it before finally the financial statement is authorized for issue. So between the reporting date and the day that the financial statement is signed or authorized for issue, those events that happens within that period, we call them events after reporting period. Events after reporting period. Between the financial statement date and the day that the financial statement is authorized for issue, some events occur. So those events, we call them events after the reporting period. So going back to the definition, there are those events, both favorable and unfavorable, which occur between the end of the reporting period and the date on which the financial statement is authorized for issue. So events happening within this period, we call them events after reporting period. Is it clear up to this point? Is it clear up to this point? Friends, the definition clear? Is it clear? Can I continue? Can I continue, friends?
Yes.
Good. Good. Okay. So these events after reporting period, we have two types of events. Two types of events after the reporting period. What are those two types? We have the adjusting events and non-adjusting events. Adjusting events and non-adjusting events. We have two types of events after the reporting period. Adjusting events and non-adjusting events. For adjusting events, it simply means that these events the financial statement must be adjusted to reflect these events. That's why we call it adjusting event. The financial statement must be adjusted to reflect these events. But for the non-adjusting event, as the name implies, you will not adjust the financial statement to reflect these. You only disclose them in the notes to the account. So these events occurring between this period, the financial statement that you are preparing for 31st December 2021, if the events are adjusting events, then you have to reflect them in this financial statement. You have to adjust them. But then if they are non-adjusting events, you don't reflect them here. You don't adjust the financial statement. You only disclose them in the notes to the account. So that's what I've said so far. What is adjusting events? They are the events after the reporting date and before the date of authorization of the financial statement, which provide evidence of conditions that existed as at the reporting date. They are events after the reporting period which provide evidence of conditions that existed as at the reporting date. So those events did not just arise or did not just arise right afterwards the reporting period. No. Although they are happening after the reporting period, but it is giving you evidence of something that already existed after the reporting date. Although it's happening after the reporting period, but probably it started way back within the reporting period. That's what we call adjusting event. Those events after reporting period that provide evidence of conditions that existed as at the reporting date. I'll give you examples, so don't worry. IAS 10 states that where there is a material adjusting event, then the financial statement must be changed to reflect this event. So you always adjust the financial statement to reflect these adjusting events if they are material. What about non-adjusting events? They are the events after the reporting date and before the authorization date. Okay, that is indicative of condition that only arose after the reporting date. So there are those events after the reporting period that arose after the reporting date. They arose after the reporting date. They don't have anything to do with the reporting period. those events only arose after the reporting date. So that's non-adjusting event. They arose after the reporting date. No adjustment is required for non-adjusting event, but possible disclosure. According to the standard, you have to disclose non-adjusting event, but don't adjust the financial statement or don't change the financial statement to reflect these non-adjusting events. Very simple as that. So with adjusting events, they existed as at the end of the reporting period. So there is evidence that they existed as at the end of the reporting period. But with non-adjusting event, they only arose after the end of the reporting period. So this is a summary of adjusting and non-adjusting events. Adjusting, there is evidence that they existed as at the end of the reporting period. But with the non-adjusting, they only arose after the end of the reporting period. Is it clear? The distinction between adjusting and non-adjusting event, is it clear? Is it clear? You shouldn't forget this, so you shouldn't forget it. It's examinable, so please don't forget it. The definition for events after reporting period, a distinction between adjusting and non-adjusting events. Usually when you ask students to give you the distinction, come and see the story that they will write. Tell them to just go ahead and tell us this. They'll be telling you stories here and there. No, please don't let it happen this time around. Okay. So if it's clear, then I think, can I repeat the types of events after reporting period again? It's on the screen, Auntie. Adjusting event and non-adjusting event. Two types of events after reporting period. Adjusting event and non-adjusting event. Adjusting events are events after reporting period that provide evidence of their existence at the end of the reporting period. But with the non-adjusting events, they are those events after reporting period that arose after the end of the reporting period. Apentin, are you okay? Apentin. Okay. Any other question? Any other question? Okay. So I'm giving you examples of adjusting event. This is coming directly from the standard. This is coming directly from the standard. Renegotiation of amounts owing by debtors or insolvency of a debtor. If a debtor becomes insolvent between the financial statement date and the authorization date, it's an adjusting event. If the debtor come for a renegotiation of the amount that they are owing, it's an adjusting event. This is according to the standard. Bankruptcy of a debtor. If a debtor become bankrupt after the end of the reporting period, it confirmed that a loss existed after the reporting period on trade receivable, right? If right after the reporting date, a debtor has been declared bankrupt, then it means that probably you should have written off that debt, because after the reporting date, that debt had become bad, but you didn't know. Is that okay? So having the information that this debtor has gone into bankrupt, then that should tell you that, hey, go back and adjust the debtor's figure, go and declare their debt as bad, or go and increase the provisions for your doubtful debt and all that. Is that okay? So bankruptcy of a debtor right after the end of the reporting period is an adjusting event. Amount received or receivable in respect of insurance claims which were in the course of negotiation at the end of the reporting period. Probably something unfortunate happened to you during the accounting period, and then you had reported it to your insurance firm, and then there was some negotiations, but in the end, you received the amounts or in respect of the claims maybe after the reporting period, where we are saying that so far as the events happen in the reporting period and then the negotiation started way before the end of the reporting period, then receiving the claim after the reporting period means there is evidence that it actually existed, right, as at the date of the financial statements. So these examples are coming directly from the standard. Discovery of errors or frauds which show the financial statements were incorrect. This is an adjusting event. Anytime you see a question on fraud and error, you are supposed to adjust the financial statements. Okay. Sale of inventories after the end of the reporting period, which gives evidence about their net realizable value at the end of the reporting period. We learned in IAS 2 that inventory should always be recorded at what? It should always be measured at the lower of cost and net realizable value. Don't know if you still remember it. It should always be measured at the lower of cost and net realizable value. So let's say you measured your inventory at cost as at the financial reporting date, right? But then between the reporting date and the authorization date, you realize that there's been a sale of this same inventory at a lower price than the cost. So it means that the net realizable value is now lower than the cost of the inventory. When that happens, you have to go back to the financial statement and restate the inventories at their net realizable value, because the standard is telling you that inventory should always be measured at the lower of cost and net realizable value. Is that okay? So measuring the inventory at cost means you are misstating the true value of the inventory. So that's it. And this is coming straight away from the standard. Valuation of a property, which provide evidence of permanent reduction in the value of the assets. This is also coming directly from the standard, and it's what? An adjusting event. If you value your property between the events, between the financial statement date and the authorization date, and the value happens to be lower than what you've stated in your financial statement, you have to go back to the financial statements and what? Adjust it. This is telling you that the true value of the item of PPE after the reporting date was what misstated. So that is it. We have a lot of examples. The settlement after the reporting period of a court case that confirmed that the entity had a present obligation at the reporting date. So after the reporting date and before the authorization date, if there is you had to pay, you have to settle for a court case, then probably the process started way back after the reporting date, right? Just don't get up and be charged to pay this amount or to receive this amount from a court case. Probably the case started way back in the reporting period, and it has now concluded. So this is the amount involved that probably you have to receive or you have to pay. So when that happens, then we treat this as events after reporting period. Is that okay? Because probably the litigation started way back in the reporting period. Subsequent determination of the purchase price or sale proceeds of asset purchased or sold before the end of the reporting period. Since the process started before the end of the reporting period, if you finally concluded it after the reporting date, you have to adjust the financial, because the process started way back in the reporting period. Receipt of information after the end of the reporting period, which indicates that an asset was impaired at the end of the reporting period, or that previously recognized impairment was not adequate. So that is it. You know, impairment from PPE. Impairment simply means a reduction in the fair value of an asset, right? So if after the reporting date you realize that the asset was impaired, why not? You have to adjust the financial to reflect it. So I have some questions here to help tease your mind and all that. So have you finally decided on the class reader? Who is our class reader? Friends, who is a class reader? Is the gentleman allowed to continue? Morrison, good. Mr. Morrison, let's hear you. Hey,
JC
you are
Limited.
giving me a lot of names. Mr. Morrison, let's hear you.
JC Limited.
Am I a boy? Is it a class rep? Is it a class rep? I've seen Amaya boy there. Are you? Oh, for the class rep, she already has marks so for being the class rep. For all the errands she'll be running on my behalf. So she already have between 5 and 10 marks, depending on her performance. Yeah, sure. Maybe I'm a marks, pal. So she already has marks. So let someone else enjoy this. Because the classroom has been calling me your assignments, you take it and be chasing me to give it to me and all that. Somebody said he's the class security. Interesting. Please, I'm also the class rep, but I only know Amma. So far, Amma will enjoy. Enough. Let's continue. Morrison, read.
JC Limited is a producer and distributor of tea. The company's year ending is 31st December. The directors of JC are due to sign the company's financial statements for the year ending 31st December 2012 on 5th March 2013. The following information is available.
Before we go to the issues, from this, what is the reporting date? From the first paragraph, what is the reporting date? What is the reporting date? Everybody, let me see it in the chat. Reporting date will be shown in there. Reporting date. Anytime you are solving event after reporting period question, the first thing you should look out for is the reporting date. Reporting date. You should always look out for the reporting date. The reporting date. You should be able to identify the reporting date. Because to know the event after reporting period, you should know the reporting date and the what authorization date. So from this question, what's the authorization date? What is the authorization date? Authorization date. What is the authorization date? What is the authorization date? Please write the date, the date, the date. What is the authorization date? Authorization date, the day that the financial statements were authorized for issue, authorization date. So in any IAS 10 question, you should be able to define these two dates, the reporting date and the authorization date. When you are able to define it, then events occurring between these two days are the events after reporting period. Events occurring between the authorization date, in this case, it's what, 31st December 2012. So events occurring between the authorization date and the financial statement date and the authorization date will be what the events after reporting period. So here's the financial statement date. And then this is the authorization date. So events between the financial statement date and the authorization date will become the event after reporting period. So please, in any question, identify these two dates. If you're unable to identify them, don't worry yourself to even read the additional information. Somebody's hand is up. Please unmute yourself and talk to me. Talk to me. Was there a mistake? The person whose hand was up, is there a mistake? Hey, was there a mistake? All right. So events occurring between these two dates will be the events after the reporting period. So anytime the event is given to you, look at the dates and find out if it's between these two dates. Sometimes we can give you events which is outside these two dates. In a typical example, I'll give you events outside these two dates. Yes, some people will analyze it and tell me it's an adjusting event. When I give you event that occurred on 6 March, it doesn't fall within what? These two dates. So it can't be event after reporting period. So take note. Now let's look at the first event. Number 1, Morrison. Mr. Morrison, number 1.
Number 1, flavor team is included in year-end inventory at its original cost of 120,000 cedis. Audits were carried out in February 2013, indicated that the team was sold for 100,000 cedis in January 2013 due to a fall in demand for such products during 2012.
Okay, so is this an adjusting event or a non-adjusting event? Who can summarize the issue here for me? What is happening in this? Somebody should summarize it for me. What is happening here? What is
Madam,
happening?
it's an adjusting event.
So what event is occurring at all? What is the event?
Madam, it's an adjusting event.
Describe the event for me. What event is occurring? Somebody is saying fall in price of closing stock. That is great. Decrease in inventory.
Madam,
Great.
Inventory was overstated by 20,000 cedis.
How was it overstated?
Because
What led to the overstatement?
during the reporting period, inventory was recorded at cost.
At cost of 120,000, right?
At cost of 120,000, yes. And before the authorization, inventory the value of inventory reduces. So the
before
company
the
has to make an
authorization
amendment
date,
in the financial
so this how
statement
you
by
should
recording the
explain it.
inventory at the.
It's okay, hold on. So before the authorization date, inventory was sold at a price lower than the cost, and that is the net realizable value. Inventory was sold at a price lower than the cost, and that's the net realizable value. When that happens, then it means that the net realizable value is now lower than the cost of the inventory. And according to IAS 2, when that happens, we have to treat it as an adjusting event. If the inventory was sold when? Audits were carried out in February 2013 indicated that tea was sold for 100,000 in January 2013. So the inventory was sold in January 2013. In January 2013 is within the event after reporting period, right? So selling inventory for 100,000 at January 2013 is indicative that the value of the inventory as at 31st December 2012 has diminished, right? Good. So it means you have to go back and adjust the value of the inventory. Good. Do you understand up to this point? Do you all understand up to this point? Do you understand up to this point? Good. Good, good. So now how do we adjust the financial statement? How do we adjust it? How do we adjust it? So this closing inventory will affect which two items? Closing inventory will affect what? The closing inventory will affect what? Hello. The closing inventory will affect which two items? The income statement and balance sheet. That is correct. So the income statement, how will the closing inventory affect the income statement? What's the effect of closing inventory on profit? What's the effect of closing inventory on profit? You should know the effects on profit before we do the adjustment. What's the effect of closing inventory on profit? Well, let me start from cost of sales. What's the effect of, are you sure it decreases? What's the effect of closing inventory on cost of sales? What's the effect of closing inventory on cost of sales? Hello, what's the effect of closing inventory on cost of sales? It decreases cost of sales. Good. Closing inventory decreases cost of sales, and we know cost of sales are also what? The lower the cost of sales, the higher the profit, right? So if cost of sales is decreasing, if closing inventory is decreasing cost of sales, then it means it is increasing what? The closing inventory will definitely increase profits. The higher the closing inventory, the higher the profit. So if the closing inventory was overstated, then it means the profits was it overstated or understated? Was the profit overstated or understated? If the closing inventory was overstated, then what's the impact on profit? Was profit overstated or understated? It was. But some people are saying overstated, others are saying understated. You want to know the effect of closing inventory on profits. That's why I started from cost of sales. What's the effect of closing inventory on cost of sales? Closing inventory reduces what? Cost of sales. If it reduces cost of sales, then it means it is increasing profit. So if closing inventory was overstated, then what was the effect on profit? It means the profit was also overstated. So to correct this, then you have to subtract the difference or the overstatement from profit. Is it clear up to this point? You have to subtract the overstatement from the profits in the income statement. So it means you have to debit the income statement. You have to debit the income statement. The end effect is that you are subtracting it from profit, because overstating closing inventory means you are overstating your profits. It means you are overstating your profits. So if you want to correct this, then you have to subtract the overstatement from the profit. Is it clear? Is it clear? Those of you saying understated, it's wrong. Profit was overstated by the overstatement of the inventory. So if you want to correct this, then you have to subtract it from profits, or you have to debit the income statement. Okay, now what about the balance sheet? What do we do with the overstatement of inventory in the balance sheet? You have to restate inventory at what? 100. And how do you do that? By subtracting 20,000 from the value of closing inventory. So it means you credit the balance sheet, right? Inventory as a debit balance and asset. So if you want to reduce it, then you credit the balance sheet, or you subtract the closing 20,000 from the closing inventory. So this is what you do to adjust the financial statement. Decrease the closing inventory by 20,000, then you decrease the profit by 20,000. That's what you do. Is it clear? You understand? You understand, friends? Then let's move on to the next event. Mr. Morrison, can you read it for us? The next event. Mr. Morrison.
During 2012, there had been industrial unrest amongst JC's production workers following automation of one of the manufacturing processes. Management had had sought to make 20% of the workforce redundant. In February 2013, the following protracted negotiations, it was agreed that 15% of the workforce would be made redundant at a cost of 400,000 cedis.
Great. So what is happening in this one? What is happening here?
Ooh, Aroma.
What's the event?
Kashanoko. Yeah, not the things. Human. Yeah, black. Pantos. The. I just.
Some people think it's not adjusting. Others also think it's adjusting. Which of them are we taking? Is it adjusting or non-adjusting? So during 2012, align it. During 2012. During 2012. And what's the reporting date? What is the reporting date? What is the reporting date? 31st December 2012, right? The reporting date is 31st December 2012. In the question, the issue starts with what? During 2012. There had been industrial unrest among GC's production workers following automation of one of their manufacturing processes. Management sought to make 20% of the workforce redundant. So all these happened in 2012. During 2012, there was industrial unrest. During 2012, this is how you analyze events at a reporting period questions. During 2012, there was what? Industrial unrest. And management had sought to make 20% of the workforce redundant. So this is what happened in 2012. Is that okay? Now, in February 2013, so it's February 2013 within the financial assessment date and the authorization date. Is it within that date? Is it within that period? It's February 2013 within the financial assessment date and the authorization date. Good. So when that happened, then we know that this is event after reporting period. So in February 2013, following protracted negotiations, it was agreed. So following what? Protracted negotiations. So it means that negotiations started way back. And we are even told that management has sought to make 20% of the workforce redundant. So they started this negotiation way back in 2012. So in February 2013, following protracted negotiation, it was agreed that 15% of the workforce would be made redundant at a cost of what? 400,000. That's now been agreed in February 2013. In February 2013, it has been agreed that 15% of the workforce should be 15% of the workforce should be made redundant in February 2013. It has been agreed that 15% of the workforce should be made redundant at a cost of 400,000. So should this be adjusted? Should the financial statement be adjusted to reflect this redundant cost? Should the financial statement be adjusted to reflect this redundant cost? Is this an adjusting event? Before you know it's an adjusting event, you ask yourself, is there any evidence pointing to the fact that this redundant cost started way back? The issues leading to the redundant cost of 400,000 started way back in the reporting period. Is there any evidence to that effect? Is there any evidence to that effect that issues leading to this redundant cost of 400,000 started way back in the reporting period? Is there any evidence like that? Because the standard says that it gives evidence of condition that existed as at the reporting date. So is there any evidence like that? Yes. During 2012, there had been industrial unrest. The management had even sought to make 20% of the workforce redundant. So all these happened during 2012. That's the reporting period. But they finally reached an agreement. They finally concluded on this issue in February 2013. So the financial statement should be reflected. This issue should be reflected in the financial statement. Is it fine? Good. So how do we adjust the financial statement? How will we treat this? 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 It's affecting which items? What is this going to affect? Think through. Labor cost, no. There's nothing like labor cost. It's redundant cost too. Redundant cost. Amount that you are paying to people for them to leave the firm is redundant cost. So it's not labor cost. Going to affect profit is going to affect operating expense. Yeah, definitely it will affect the income statement as what an expense. To affect the income statement as an expense, redundant cost as an expense. So it's going to affect profit, redundant cost. What about the balance sheet? What item is it going to affect in the balance sheet? Will it affect cash? Will it affect cash? Cash at hand, really? Are you sure it will affect cash at hand? Were we told that they paid physical cash to them? Were we told of any cash being paid? Look at it again. In February 2013, following the protracted negotiation, it was agreed that 15% of the workforce would be made redundant at the cost of this. Were we told that they were giving cash? No. Hey, somebody is saying it will affect inventory in the balance sheet. As I'm not saying. Hello, this is not affecting cash. Provision, yes. A liability because they did not pay any cash. They only agreed at a redundant cost of this. So it's a liability. So you create a provision for redundant cost. The name of that liability will be provision for redundant what cost? Provision for redundant cost, and it will be part of other liability, 400,000. So that in future, when they pay the amount, you debit the liability account and now you credit cash. But now they've not paid any cash. They've only decided and reached a conclusion. So you make a provision for it in the financial statement by debiting your your income statement. That's making it affect your profits, or adding it to your expenses. Then you credit your balance sheet by creating a liability called provision for redundant cost, 400,000. So you credit your liability, other payables. Under the other payables, it should be provision for redundant cost, 400,000. And you go to the income statement under the expenses, provision for redundant cost is an expense. Is that okay? And that one will affect your profit. Double entry should affect two items. So it is going to affect your profit and your liability. Your profit is reducing and your liability is also increasing. Is it clear? Is it clear up to this point? Is it clear up to this point, friends? It's not affecting cash. It only affects cash when you make the payment. And when you make the payment, you now debit the liability account to cancel it, and then you credit your cash account when it's finally time to make the payment. All right. Let's move on. My friend, the next one, Morrison. Mr. Morrison.
But
Mm-hmm.
on 31st January 2013, 250,000 cedis was paid to Rosie Rock as compensation for a removal of managing director. Ms. Rock has been dismissed by the chairman at the December 2012 board meeting as a result of a serious disarrangement over marketing strategy for 2013.
Okay. What is happening here? What is happening here? Is it an adjusting event or non-adjusting event? What is happening here, friends? Adjusting or non-adjusting? Adjusting or non-adjusting? On 31st January 2013. January 2013. Mm-hmm. 250,000 was paid to Rosie Rock as a compensation for her removal as managing director. Ms. Rock has been dismissed by the chairman at the December 2012 board meeting. The reason why we are paying her the compensation is as a result of her dismissal in December 2012 board meeting. So this 250,000 we are paying to Ms. Rock. This money we are paying to Ms. Rock is in January 2013. It's as a result of her dismissal in December 2012. So should this payment be adjusted in the financial statement? Should the payment be adjusted in the financial statement? Should it be adjusted? Yes, because there is evidence that this condition existed as at what? The reporting date. Ideally, as at the time that he was dismissed, the money should have been given to her, right? But she was just dismissed, and in January 2013, the money was paid to her. So it's an adjusting event. The financial statement should be adjusted to reflect this event. How should we adjust it? How should the adjustment be made? How should the adjustment be made? Income statement and balance sheets. Yes, it's affecting income statement and balance sheets, but the other things you are writing, they are wrong, Mr. Marcos. I need more answers. So, in the income statement, how should I treat it? Yes, definitely I should add it to the expense. That is correct. So it will reduce the profit, right? In the income statement, I have to add it to the expense to reduce the profit. But in the balance sheet, how is it going to be treated in the balance sheet? How is it going to be treated in the balance sheet? Those of you saying cash, 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 cash. When was the money paid to Miss Rock? When was the money paid to Miss Rock? When was the money paid to Miss Rock? The money was paid in January 2013. So as at December 2012, no money had been paid to Miss Rock. So this will not affect cash. Remember, we are preparing the financial statement to 31st December 2012. As at that time, no money has been paid to Miss Rock, so it can't affect cash. So we can only make a provision in the financial statement. Can only make a provision, a liability, current liability. Yes, here it is current liability because the money was paid in January 2013, a month afterwards the reporting period. So it's a current liability. As at the reporting date, we have to treat this as a current liability because the money was paid in January 2013. So that when we get to 31st January 2013, we now debit the liability account and we credit the cash account. Did you get it? This is financial accounting. No, this is financial accounting. You learn these things in the financial accounting. Double entry, correction of errors, double entry. You learned all these in the financial accounting. So it will affect profit and current liability. So in the profit and loss account, we will treat it as an expense, right? And when we come to the balance sheet, we should create a liability, current liability, right? I hope you all understand it up to this point. You all understand it up to this point. So maybe you can call it compensation cost or something. Compensation, cost of compensation or something. Is it clear? Friends, is it clear now? Is it clear? So for everything we are doing here is not financial reporting. No? The only financial reporting here is the fact that whether you should treat it as adjusting or non-adjusting. Otherwise, the double entry things, you learned it in financial accounting. And the correction of errors, you learned all these things. So you just have to apply these things, that's all. Good. We move. The final one for this question, Mr. Morrison. Mr. Morrison.
It was discovered in January 2013 that a long-serving employee had systematically stolen 250,000 cedis over the previous 4 years. Material errors had that been made in the financial statements over those years, and there is now no chance of recovery. Requirements.
It's okay. This is the requirement for the whole question. So with this issue, is it an adjusting or non-adjusting event? Adjusting or non-adjusting? Remember when I was giving you example for adjusting event, it was there. Fraud and errors was there. When I say non-adjusting, when you see fraud or error in any exam question, please, it's an adjusting event. But the standard make it clear that fraud and error is an adjusting event, so you have to adjust. Is that okay? Fraud and error is an adjusting event, so you have to adjust. But sure, the example that I gave you, master them. Master the example that I gave you. Please master the example that I gave you. All right. So we'll move on. So everything we've done so far, they are all adjusting events. So when you get a slides, you have the solutions in here. Giving you the solution for issue 1, solution for issue 2, solution for issue 3, issue 4. Now let's move on to non-adjusting events. As I've already explained, event after the reporting date and before the date of the authorization of financial statement that is indicative of conditions that arose after the reporting period. They arose after the reporting period. They do not result in changes in the amount recognized in the financial statement. However, you should disclose them if they are material. If those issues or events are material, disclose them in the notes to the account. Disclose them in the notes to the account. Do you know why you have to disclose them? To help users of the financial statement make an informed decision. To help users of the financial statement make an informed decision. So, if it's material, disclose it. Don't what? Adjust the financial statement. So what should you disclose? Disclose the nature of the event and the estimate of the financial effects. You're supposed to estimate the financial effects of the event. And so estimate it and then put it in the notes to the account, and then the nature of the event that occurred, describe it, and if there is any explanation, give it. So that's the kind of disclosure you make for non-adjusting events. Is that okay? All right. So the standard has given you examples of non-adjusting event. Fire outbreak after the end of the reporting period. Fire outbreak after the end of the reporting period. This is coming straight away from the standard. So you have to sort of memorize them. It will help you. So that when you see them, hey, there's non-adjusting. Hey, there's adjusting. But when you take your time and analyze it, it will make sense to you as to whether it's adjusting or non-adjusting. Fire outbreak. It's a natural disaster, right? To nature to baby. I mean, it's a non-adjusting event. Closing a significant part of the trading activities, if not anticipated at the end of the reporting period. Acquisition or disposal of a subsidiary after the end of the reporting period. Major purchase or disposal of assets after the end of the reporting period. So between the financial statement date and then the date the financial statement is authorized for issue, if any of these events occur, just disclose them in the financial. Don't adjust the financial statement. Announcing the plan to discontinue an operation. Commencing major litigation arising solely out of event that occurred after the end of the reporting period. When you get a slide, take your time and read it. Just take your time and then read it. You realize that it's all making meaning to you, that the fact that you don't have to adjust these events. Decline in the market value of investment between the end of the reporting period and the day the financial statements are authorized. Decline in the value of property and investment held as non-current assets if it can be demonstrated that the decline occurred after the end of the reporting period. So in a question, it will give you all these for you to know whether it's what adjusting or non-adjusting. So there's a question here. Somebody's hand is up. If you want to ask a question, please go ahead. Rexford. Otherwise, Morrison, if you can read for us. Rexford, if you have a question, unmute yourself and then go ahead. Otherwise, Morrison, please read a question for us.
Okay, madam. Richsam Limited is a furniture manufacturing company. The company was informed on 1st February 2013 that one of its major customers, Dumpus Limited, had gone into liquidation. The liquidator indicated that no payments would be made to unsecured creditors. The amount owned by Dumpus Limited on 1st February 2013 amounted to 55,000 cedis, of which 30,000 cedis related to goods invoiced on 10th December 2012 and 25,000 cedis to goods invoiced on 15th January 2013. Requirements. Explain how the above item would be dealt with in the financial statements of Richsam Limited for the year ended 31st December 2020.
So please, in 3 minutes, analyze the question and give me your answers. How you would treat this. Whether it's an adjusting or non-adjusting, and how it should be treated. Analyze it in 2 to 3 minutes. Because this will be an MCQ question. I told you all the questions you are seeing in the slides. They will all be MCQ questions. You have 2 to 3 minutes. 1 minute's gone. I need more answers. So a few people have given their answers. Somebody is saying adjusting, another is saying adjusting. Some people also think a part is adjusting and then a part is not adjusting. What is your answer? What is your answer? Most of you are saying part is adjusting and the part is not adjusting. So I think we should go and find out what is in there. So Rich Sam Limited, furniture manufacturing company. The company was informed, let's take note of the dates. The company was informed on 1st February 2013 that one of its major customers, so 1st February fall within 31st December and 5th March, right? So this event is important to us. So they were informed that one of its major customers, Dompost Limited, had gone into liquidation, bankruptcy, liquidation of a customer. They are all what? Adjusting event according to IAS 10. But let's read further. The liquidator indicated that no payment would be made to unsecured creditors. The amount owed by Dompost Limited on 1st January 2013, that's the debtor, amounted to what? 55,000. So the debtor who had gone into liquidation is owing the firm Rich Sam 55,000, of which 30,000 related to goods invoice on December 10th, 2012. So this 30,000 is definitely an adjusting event. The customer had gone into liquidation, and the event happened in what? December 2012, within the reporting day. So 30,000 is an adjusting event. And 25,000 of the goods was invoiced in 15th January. Was invoiced on 15th January 2013. In as much as a customer going into liquidation or bankruptcy is an adjusting event, this event happened after the reporting date? It happened after the reporting date. So the 25,000, which was invoiced in January 2013, will be disclosed. That's non-adjusting event. So it will be disclosed in the financial. Now this customer whose debt was written off also has another debt. Okay, also has another debt. Goods were sold to him on January, is it January or February? Goods were sold to him on January 13th. So you just disclose the amount involved. But that one you won't adjust because the transaction occurred after the reporting period. So you adjust 30,000 and disclose 25,000. 30,000 is an adjusting event, 25,000 is non-adjusting, so you only disclose. Is it clear? Is it clear, friends? Is it clear, friends? Is it clear, friends? In as much as the bankruptcy or liquidation is an adjusting event, it should have happened. The sale of goods to the person who is gone into bankruptcy should have happened within the reporting period before you would adjust. Good. So do I have more questions? No. So that's the solution for you. When you get a slice, it's there. So the solution is here. Now, going concern consideration. IAS 10 requires that an entity should not prepare its financial statement on a going concern basis if management determine after the reporting period that it intends to liquidate the entity or cease trading. So if after the reporting period you think you intend to liquidate, then don't prepare your financial statement on the going concern assumption. You learn going concern, right? The probability that the entity will continue to exist in the foreseeable future. And you were told that you should always prepare the financial statement on the going concern assumption, right? So the standard IAS 10 is telling you today that if the company intends to liquidate or cease trading, they shouldn't prepare the financial statement under the going concern assumption. They should disclose that they intend to cease trading, blah, 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 in the notes to the account. Is that okay? And then if it has no realistic alternative but to liquidate, then they shouldn't prepare their financial statement on the going concern basis. Although organizations are supposed to prepare their financial statement on the going concern basis. If the company intends to liquidate or they have no realistic alternative but to do so, then they cannot prepare their financials over the under the going concern basis. So take note of that. So if they intend to liquidate or they have no realistic alternative but to do so, then they have to present their financial statement on the non-going concern assumption. Non-going concern basis of assumption. So over there, they will just say that because they intend to liquidate or they intend to cease trading, then they will say that the financial statement has been prepared under the non-going concern basis. They have to clearly state it in the notes to the account. All right. Then issue some proposed dividend. So I hope you know dividend. Were you introduced to company in financial accounting? Introduction to company. Did you learn that in financial accounting? Friends, did you learn introduction to company account? Did you learn it? You know dividend? No. Okay. A dividend is the return that you pay to somebody who have what? Investment in a company. The return that we pay to you, we call it dividend. If you have any investment in a company, the return that we pay to you, we call it dividend. If somebody gives a loan, the return that is paid to the person is called what? Interest. When you invest in shares, or when you invest in a company, the return we pay to you, we call it what? Dividend. Good. So to accrue dividend at the reporting date, they must have been approved by shareholders at the AGM prior to the reporting date. So what are we saying? Before you can account for dividend in your financial statement, there should have been an annual general meeting within the reporting period where dividend was approved. Otherwise, you don't account for dividend in the reporting period. You only disclose it. You only disclose it. So the proposed dividends by the directors was done before the reporting date, but the AGM does not take place until after the reporting date. Then dividend cannot be approved, but must be disclosed. So usually the directors of the firm will propose a dividend, but it has to be approved by the shareholders at an annual general meeting. So what we are saying here is that if the annual general meeting is not held, if it's not held before the reporting date, okay, or if it's not held within the reporting period, for it to be approved by the shareholders, then you don't have to account for the dividend in the financial statement. You only have to disclose it. Accounting for dividend simply means that you subtract it from your profits, right? The dividend that you are paying to your shareholders, you subtract it from your profit. But if it was paid with cash, then you credit cash. But if it's not paid within the reporting period, then you accrue it as what? A liability. You call it dividend payable. That's how you account for the dividend in the financial statement. But what we are saying here is that if it wasn't approved at an AGM within the reporting period, then you only disclose it. You wouldn't account for it, as I've explained. Is it clear? AGM is annual general meeting. So is my explanation clear? The AGM should have been held within the reporting period for them to approve the dividend. If that was not done, if the AGM was done after the reporting period, then you can't account for dividend in the financial statement. You can only disclose it in the notes to the account. And how do you account for the dividend in the financial statement? I've told you that you subtract it from the profit by debiting the profit and loss account, and then crediting either the cash if it's paid by cash, or crediting liability, dividend payable. Is that okay? If you accrue it. But before you do that, AGM should have approved of it within the reporting period. Otherwise, you can't account for it. You can only disclose it. I believe it's clear now. Is it clear now? Okay.
Madam,
please,
the dividend, would it be like, would they state in the question that like they have approved it before you account for, or like it would be like maybe they will write only dividends? But how will you know that they have approved it or not?
If the AGM was held, the date will be given to you. The date of the AGM will be given to you. The day that the AGM was held to approve the dividend will be given to you. And the day that the board of directors proposed, the day that the AGM was held, all of those information will be given to you in a typical company question. So that information should help you to know whether you should account for it or you should just disclose it in the notes to the account. And in every company question, there will definitely be dividend issues, whether you should account or you shouldn't account. So the information there will let you know. So in any company question, when there is a mention of dividend, look out for the day that the AGM was held. So that one is crucial. Are you okay? The day should be within the reporting period. Otherwise, then you don't have to account for it. You just have to disclose it.
Yes.
You don't have to
Yes, please, I'm okay.
like reflect
Thank you
it
very
in the
much.
finance. Most welcome. All right. Sorry. Now, dividend declared after the end of the reporting period is a non-adjusting event, so it should therefore be disclosed. Dividend due from subsidiaries are not income in parent individual account if declared after the end of the reporting period. This one will be meaningful to you when you get to final year and you learn groups where dividend from subsidiaries, parent, associates, and those things. Yeah, there wouldn't be any question on this thing because it's beyond you at this point. So what have we learned so far with regards to IAS 10? We have learned what adjusting event is and what non-adjusting event is. We know events after reporting period, and we know which of them we should adjust and which of them we should not adjust. If the event after reporting period is an adjusting event, then you have to adjust the financial statement to reflect it. If the event after the reporting period is non-adjusting event, then you only have to disclose it. This is what we have learned so far. And how will you know if an event is an adjusting event? If it's giving evidence of a condition that existed at the reporting date. If it's not an adjusting event, then it's only a rule. The event only arose after the reporting period. You only disclose non-adjusting events. You will adjust the financial statement to reflect adjusting event. This is what we have learned. This is the disclosure requirement for events after reporting period. You have to disclose the date of the authorization of the financial statement, who gave the authorization, the owners, or otherwise have the power to amend the financial after the issue. It must be disclosed. So these are the information that you have to disclose. And how would you know the authorization date? Usually when you see the financial statement in an annual report, you realize that the financial statement has been signed. The person who signs name will be there. So that's how you get to know the authorization date and who gave the authorization. So after today's lecture, just go pick any annual. You can go to Ghana Stock Exchange, download the annual report, and look out for the financial statement. You see that it has been signed. The financial statement has been signed. Look at the dates. That's the authorization dates. Then who signed the financial statement? So that is it. Any question for me on IAS 10? Otherwise, we'll start with IAS 10. Any question on IAS 10? Any question on IAS 10? Any question on IAS 10, friends? Any question on IAS 10? Friends? There is no question.